A health savings account is a tax advantage account that can help you pay for qualified medical expenses. In this video, we explain how these accounts work, how they can help you save on taxes, and how to maximize them to help offset future healthcare costs in retirement. That's coming up, so stay tuned. Hi, I'm Jerome Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider subscribing to our channel. As health insurance premiums and other medical costs continue to rise, health savings accounts, also known as HSAs, have grown in popularity as consumers seek more flexibility and discretion over how their healthcare dollars are spent. HSAs are attractive to many people because they provide a tax-advantaged way to pay for eligible medical, prescription, dental, and vision expenses. However, HSAs are not available with all FEHB plans. To open a health savings account, you have to enroll in a high-deductible health plan, and you cannot be covered by any other health insurance, including Medicare and TRICARE. Since HSAs are linked to high-deductible health plans, I want to quickly explain how these types of plans work. As the name states, high-deductible health plans typically have a higher annual deductible than traditional plans, but these plans generally have lower monthly premiums. The IRS and tax laws actually define some of the parameters for a high-deductible plan. For 2023, the minimum deductible for a self-only plan is $1,500, and for a self-plus-one or self and family plan, the minimum deductible is $3,000. There's also a maximum out-of-pocket limit, and that amount is $7,500 for self-only plans and $15,000 for plans that cover you and a family member. High-deductible health plans provide preventive care to you without a cost. However, when you need non-preventive care, you pay the full cost of that care with funds from your HSA or out of pocket. If you reach the maximum out-of-pocket limit that I mentioned earlier, your health plan will provide needed care with no charge to you as long as you use in-network providers. Despite being associated with high-deductible health plans, HSAs are still very appealing because they offer a triple tax advantage. First, your contributions are tax-free. Your contributions can be made pre-tax through a payroll deduction, or you can contribute to your HSA post-tax and receive the same tax savings by claiming the deduction when filing your annual taxes. HSAs offer a second tax advantage because your interest and investment earnings in a health savings account grow tax-free. Then thirdly, distributions from an HSA are not taxed if used to pay for qualified medical expenses for you, your spouse, and your dependents, even if they are not covered under your health plan. HSAs are administered by financial institutions, but they are partly funded by your health plan with a premium pass-through, which is a portion of your monthly premium. Many of the FEHB plans provide a premium pass-through that ranges from $900 to $1,200 per year, or double that amount if more than one person is covered under your plan. You can also make extra tax-free contributions to your HSA as long as your individual contributions and premium pass-through do not exceed the annual contribution limit. For 2023, the limit is $3,850 for an individual and $7,750 for a family. An additional $1,000 catch-up contribution is allowed if you are between the ages of 55 and 65. An HSA does not require you to re-enroll each year, and it does not have a carryover limit. Any unused balance in the HSA automatically rolls over from year to year, and the funds remain your assets if you switch plans, change employment, or retire from federal service. Plus, if you later become ineligible to contribute to the HSA for any particular reason, you are still able to withdraw from the HSA to pay for qualified medical expenses, including your copays, coinsurance, deductibles, Medicare Part B premiums, and long-term care premiums. Most health savings accounts allow you to conveniently access your funds through a debit card, checks, and online bill payment. If you withdraw funds from your HSA to pay for non-medical expenses, income taxes would need to be paid on the distribution amount. If you are under age 65, an additional 20% penalty will be assessed on the amount withdrawn. Once you reach age 65, you won't pay the 20% penalty, but the distribution will still be subject to income tax. An HSA does not have required minimum distributions when you reach age 72, like your TSP accounts. Additionally, you have the right to designate a beneficiary or beneficiaries to receive your remaining HSA funds when you pass away. With a spousal beneficiary, your HSA will be transferred to your surviving spouse, and he or she will receive all the benefits of account ownership. Your spouse can continue to make tax-free withdrawals to pay for eligible healthcare expenses. If you designate an individual other than your spouse, the remaining balance of your HSA will be distributed to the beneficiary and taxed as income at fair market value in the year that you pass away. So it's an HSA right for you. The final verdict may depend on several factors, including your healthcare status, your emergency savings fund, and your future retirement goals. Health savings accounts may be most attractive to an individual or family that has relatively limited medical needs and expenses, can afford to pay out-of-pocket healthcare costs, and could take advantage of the tax benefits and long-term savings of an HSA. If you choose to enroll in a high-deductible medical plan with an HSA, it can be helpful to think about your HSA as an additional retirement account that is specially designed to cover medical expenses. Here are a few points to help maximize the long-term value of your HSA. Contribute to your HSA each year up to the maximum allowable amount. Allow your HSA funds to compound over the years by paying most of your unreimbursed medical expenses with after-tax dollars. And invest the money in your HSA for long-term growth, similar to your TSP and other retirement accounts. In retirement, when you generally have more healthcare costs, use your HSA to pay for qualified healthcare expenses. If you received any value from this video, please click the like button. And I enjoyed hearing from you. So please add any responses or questions in the comment section below. Thanks for watching, and we'll see you on the next Money Briefing.